In this week's update, markets doing what they always do at the start of serious conflict. Oil and gas surging, and otherwise a mix of positive and negative events. My name is Garry Davis. I'm an authorised representative of Primary Securities, and the information presented here is general information only. All right, obviously a week of turmoil, maybe surprises depending on your view, maybe not. But let's have a quick look at the current status. The Middle East conflict is obviously the most significant talking point at the moment, and that just tosses in another layer of uncertainty, which markets generally hate, but we seem to have had a fairly mild response from global markets at this point in time. Now, that could change because there are ongoing events over the weekend in that region, but at the moment, the markets are still relatively relaxed with what's happening, but nevertheless, there is uncertainty. So I would sort of describe it as markets are underreacting. But look, we've got a situation where the conflict could go in any one of a number of directions. There could be significant disruptions to oil transportation. There are many things that could change in a very short space of time. So it's certainly a very fluid situation. Now, in both America on Friday night and also in Australia during Friday, there was certainly some profit taking in certain sectors of the market. And as is normal, that profit taking, a lot of it was centered on stocks that had done very well recently, in recent weeks, recent months. And so people that had very significant fast profits were taking some of those off the table. But as a general statement, the volumes were pretty modest. So this was really looking more like the buyers just stepping back to see what happened, rather than an avalanche of sellers overcoming the buyers. So nothing terribly dramatic at this stage. Now, of course, as usual, you need to make sure that you get all the relevant advice, financial, legal, and any other professional advice that you need before investing. Because, as I say every week, it's easier to lose money in the stock market than it is to make it. So you need to make sure that you're approaching this in the proper manner. Let's have a quick look at the American stocks. The S&P was down 0.4% and the NASDAQ by 0.6% for the week. The positive was that there is now a framework for the US and China to work towards a trade agreement, and that certainly helped settle the nerves to a degree. The May CPI came in below forecast, so that also helped as well. And we saw, obviously, energy was by far the leading sector, up nearly 4% because of what's happening in the Middle East. But there's a bit of forward projection and conjecture on that one because there has not been any interruption to oil supply at this point in time. So that's the market anticipating where things could go. But healthcare was also a pretty good gainer on the week, up nearly 2%, but that's really a result of some major deals being done in that sector. So a bit of a one-off. US dollar has fallen back below 100 again. We're back now to 98. And the 10-year yield eased back a little bit, 4.41. So that's remarkably stable. The VIX kicked up a little bit. We were 16 last week. We're almost 21 this week. But look, that's not too bad in the overall scheme of things. And that sort of validates what I said with respect to the market reaction to the Middle East conflict. It's just the VIX has not gone up nearly as high as you perhaps might have thought it would. Now, if we look at the NASDAQ, the Friday finish was not optimum. The prices gapped down, which is normal because of the conflict in the Middle East. We then traded back on the NASDAQ, almost back to neutral. So you can see we opened down with a gap, traded right up to neutral, but then the sellers finished off the day and took control back. But they did it without massive volume. So yes, the sellers were in control at the finish, and that may mean we're going to get more follow through next week. But if you look at it on a individual stock basis, the volumes just weren't there to look scary from my perspective. And I looked through more than 100 American stock charts, and there were very few where significant volumes were the order of the day. So at the moment, the market is digesting this situation fairly well. The point I'd like to make here that's really valid is the obvious logic is we've got a war in the Middle East. There could be nuclear ramifications to it. we could have a significant interruption to oil supply, which would spike the oil price and spike inflation. So there's a whole lot of things that could go wrong. So the obvious logical conclusion is that markets should be selling off. But at this point in time, more money flows are remaining strong on an individual stock basis, and there are more buyers than sellers. So no matter what else you think, at this point in time, there are more buyers than sellers, and that's an inarguable fact. And I'm reminded of something that I heard and read several times since from many, many years ago, and that is that more money has been lost anticipating corrections, jumping to conclusions, whatever you want to call it. And at this point in time, we are far better off responding to the money flows rather than the fundamentals and the logic that you might think goes with that. Let's look at some of the spreads. This is the S&P versus gold. Gold shot up. So naturally, we've seen that ratio start to fall again. If we look at consumer discretionary versus consumer staples, it's remained very stable. So again, there's no real panic to get out of the more aggressive consumer discretionary sector. And if we look at, this is the NASDAQ versus the S&P, so growth remains very much in control in that relationship as well. Over the last month, the American sectors, we saw a very good week for healthcare, but we certainly saw some sharp selling, and also energy, of course, has come from the bottom of the pack just a couple of weeks ago and is rocketing up where all the other sectors took a bit of a breather. And in Australia, we saw energy do well for part of that period, but sold off towards the end. But the real beneficiary was the information technology sector, and that had a very, very strong finish to the week. So that's where we sit in America. If we're looking at the S&P, this is on a daily chart. It's a similar situation. We had a gap down, we traded up, we didn't quite make it to break even, and then the sellers came in, but volume's just not threatening at all from my perspective. The equal weight S&P on a weekly chart gave back a little bit, and so did the Russell. If we have a quick look at currencies, DXY, we had two sharp days down, Wednesday and Thursday. We got a bit of a rebound on Friday, which, given what's happening with the American economy and American policy and American debt, it still confuses me that we're seeing a bit of a flight to safety with the US dollar. So a little bit of a rebound, but maybe that relationship is going to break down over time. And if we look at the Australian currency, not a lot changed for the week, slightly higher, but nothing too dramatic there. All right, moving on to Australia now. The Aussie dollar, 64.31, and that's largely because the US dollar has hit its lowest level in 3 years. The ASX 200 rose 0.4%. Absolutely no idea what will happen when the market opens on Monday, because we've had a bit of a negative session in the US, but there are lots of things happening in the Middle East, so a lot of things could change between now and Monday morning. But you'd have to say that the Australian index over the last several weeks, and particularly to finish the week, has shown great resilience. And that comes as a bit of a surprise, because the Australian index is certainly not on the cheap side at the moment. Energy was the obvious big winner, but did cool off a bit there at the end. But in the small and mid-cap category of the stocks that I focus on and talk about regularly, which I kind of term the best of the best, it was just the normal profit taking that happens every time we get a nervous situation. The stocks that have done really well in recent weeks always cop a hit. So you don't want to overreact to that, because it's just the way it is. So just relax when it comes to the Australian market at this point in time, unless the market starts showing us something different. All right, precious metals now. Gold had a very strong finish to the week, up $122 to finish at $34.32. And when we translate that to Australian dollars, we get almost $5,300. So we're starting to make ground to the upside again. Silver did well after really rocketing the week before, managed to hold its ground in the mid 36s. We've got gold at a triple top, and a breakout would appear to be the more likely scenario, as we'll see in just a minute. In fact, I'll go and look at that right now. So we'll start first of all with silver. So there's silver, very significant breakout, quite a long tail, but the buyers stepped in again on Thursday, and similarly on Friday, not a lot of movement. There's the gold price on a daily basis, and we're looking at a triple top situation at the moment, and the more likely eventuality is that this is going to break out in the near term. And there is the Australian dollar gold price. Okay, so turning to other commodities now, copper was down a little bit, $4.74. Nickel was at $7, and it ended up being a pretty flat week for copper. And of course, crude oil was the big winner, up to $73. And what a difference a war makes to the price of oil, because it was only a few weeks ago that we were looking at oil sub $60 down to around 58. And a disruption to transportation, though, would certainly spike oil prices and spike inflation as well. So that would be a real game changer for equities markets, that's for sure. But we'll just have to wait and see on that. That's the crude oil chart. There you can see we got down under 60 very briefly, but it's rocketed back up now, up into the mid 70s. So that's it for this particular update, and I'll be back with you next week. Cheers.